Hello everyone. It gives me a great pleasure to interact with all of you through a virtual medium which seems to have now become a new normal. In this video, I am going to talk about a new fund offering on the debt side, Invesco India Medium Duration Fund, which we believe could be a part of core fixed income portfolio for every medium to long term investor, and it is also positioned to capitalize upon some of the current opportunities in the fixed income market. But let me first set the context here. Last year has been the most disruptive one, both on health hazards and also on the economy, which was caused by the pandemic. No other crisis in our lives, even including the global financial crisis in 2008, come even close to this one. Most of the countries reacted in a very synchronized and a coordinated way with loose fiscal and monetary policies to mitigate the impact on economy to the extent possible. Domestically also, RBI came into very quick action and played a more dominant role in supporting economy through its various policy actions. RBI also provided clarity to the market participants whenever there was a doubt on market concerns like financial stability, inflation, systemic liquidity, higher fiscal supply, and etc. This year began on a promising note with successful launch of vaccinations in many countries, although some of the countries have been again impacted by the second or the third wave of pandemic, and it seems that each and every country as of now could be at different junctions in terms of growth recovery and the various policy actions taken by them. Let me now broadly talk about the various concerns that the fixed income investors in India are facing as of now. First, global hardening of interest rates and its impact on Indian fixed income market. Second, RBI's monetary policy and the fears of unwinding of loose monetary policies. Third, and the foremost, what segment of the fixed income to invest in given the current low yields as of now. Let me now address them one by one. First, on the global concerns of interest rate hardening. No doubt that if the global rates were to harden, all the economies including India will be impacted to an extent. However, Indian fixed income market could be relatively more resilient to such global volatilities as the foreign investors hold just about 1.5 to 1.6% in Indian G-Sec market, which is actually negligible as compared to the foreign investors holding in many other emerging countries, which means that any selling by foreign investors as such is not expected to bring much of a volatility in domestic interest rate. Secondly, India's forex reserve is at all-time high of over 600 billion US dollar, and it provides adequate cushion to absorb global volatilities from currency perspective. All these factors have been tested since January 2021, when US 10-year G-Sec has hardened sharply by about 65 to 75 basis point, led by strong growth recovery and inflation fears. However, Indian 10-year G-Sec on the other hand has hardened by only about 15 to 20 basis point. INR also has been one of the top performers across many other countries, reflecting the resilience. So the point to note here is that Indian rates may be more influenced by domestic factors like the growth inflation dynamics and not really by the global factors to an extent. And that is where the role to be played by RBI becomes even more critical. Let me now talk about the second concern on RBI's unwinding of the loose monetary policy. Last year, RBI took the proactive policy actions to lessen the impact of COVID-19 on economy, and growth support seemed to be the main agenda of RBI even when the inflation was a big concern. While we were able to see the green shoots in the economy early this year, COVID-19 second wave has just put sudden brakes on the nascent recovery. Not only the immediate economic impact, it also raises the concerns on growth outlook due to the subsequent waves, if any. We believe that only a successful vaccination of large part of population can really address these concerns, and in India's context, that is expected only by this year end. On inflation, RBI has projected an inflation of 5.1% for financial year 22, which is lower from 6.2% in financial year 21, and as such it is within the 2% to 6% inflation targeting framework. Inflationary risks can emanate from supply side disruption and also rise in the global commodity prices, as it is also witnessed in the recent CPI print. However, with the growth uncertainty continuing for most part of the current year, we expect RBI to stay growth supportive by maintaining current low policy rates and the surplus systemic liquidity in this year. Thereafter also, RBI policy measures will depend on the sustainability of the growth recovery as long as the inflation remains within control. Additionally, RBI's various other liquidity management tools like government securities acquisition program, open market purchase operations and Operation Twist are expected to reduce the volatility across the rate curve and also ensure the orderly evolution of the yield curve by timely addressing the market concerns. So, with this backdrop, the real question comes where to invest in Indian fixed income market as of now. Overall, we feel that 1 to 5 year segment of the yield curve continues to provide attractive opportunities from risk reward perspective on the back of accommodative policy stance, surplus liquidity and also the favorable demand supply dynamics. With relatively lesser volatility, this segment should be a part of core fixed income allocation depending upon the investment horizon of each individual investor. Longer end may remain more volatile due to the continuing fiscal concerns. However, current yields at longer end provides the benefit of high accrual and some tactical allocation towards the longer end also finds merit on the back of conviction that RBI will actively manage the entire yield curve. On the credit market, it seems the environment continues to remain tight as of now due to the COVID-19 led disruption, and as such any broad based recovery is many months away from now. Accordingly, one has to be very stringent on the credit selection. With the context set, let me now talk about our new fund launch, Invesco India Medium Duration Fund, which has a mandate to maintain the Macaulay duration of the portfolio between 3 to 4 years. If you look at the yield curve, it has steepened sharply since pandemic, with short end of the curve coming down by almost 150 to 160 basis point on the back of more aggressive reverse repo rate cuts by RBI and also the benign liquidity. Long end like 10-year space has also come down, but to a much lesser extent by about 50 basis point as higher fiscal supply concerns continue to linger upon. So, for the new fund, we have identified the 3 to 5 year segment as core book, which is neither too short in tenor to be impacted by low YTMs, nor too long, which can be impacted by the rate volatility. This segment is also in line with the investment horizon of medium to long term investors and close to the overall maturity profile of the fund. While this segment will provide the benefit of relatively higher yield, this may also benefit from the yield compression due to the normalization of yield curve. For instance, 5 year GSEC is currently at about 1.5% higher yield than the policy repo rate, which is almost double of the last 10-year average. Another opportunity that the fund intends to capitalize upon is on credit quality dispersion, which has led to a very high credit spreads as of now. While any generic improvement in the credit market is still some time away, very stringent selection of 5 to 10 AA category credits can still be possible without really compromising upon the overall credit quality of the portfolio. So, depending upon the credit cycle, the fund intends to deploy about 15% to 25% of the portfolio in very selective AA category credits, which are expected to have improving trajectory going forward. For instance, the fund has identified few sectoral themes like commodity, and telecom sectors, which are expected to be benefited with the new global order post COVID-19. Additionally, the fund aims to identify few specific issuers which are expected to witness improvement in their credit matrix on the back of the events like IPOs or significant debt reduction plans. Such credits will not only provide the higher accrual to the fund, but also the mark-to-market opportunities with credit spread compression due to the improvement in credit matrix. These issuers will be filtered through our in-house comprehensive bottom-up credit assessment framework, which is an integrated approach to risk-reward based security selection and also for the portfolio construction by combining the macro analysis, credit beta modulation, thematic ideas, internal credit ratings, and also the relative value ratings. This is then overlaid with strong granular and independent risk management framework. 75% to 85% of the fund will still be invested in AAA rated or sovereign assets, so as to maintain a superior asset quality at the portfolio level. As a discipline, fund does not intend to invest in single A or below rated papers at all. Overall, we believe that this fund provides a right blend of maturity profile and also the superior asset quality while providing yield pickup for medium to long term investors, and it also aims to enhance the return potential by spotting mispriced assets and also the credit spread compression opportunities. Let me summarize the key points of this fund once again. This fund will have a majority allocation in 3 to 5 year instruments. Fund will maintain a very superior asset quality with 75% to 85% in AAA rated or the sovereign assets. Selectives 15% to 25% exposure to be taken in AA category, which will provide a yield kicker to the portfolio. No intention to invest in single A rated or the below rated categories at all, and the fund will aspire to maintain higher return generation through active relative spread movement. So, with all these attributes for the fund, we believe that this fund is quite well suited for medium to long term investors with moderate risk appetite. With that, let me close and wish that everyone stays safe and healthy in the ongoing pandemic situation. Thank you very much, and looking forward to your support and participation to our new fund launch.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.